you will be knowing that every week on the last Friday, we used to release the Nifty future and Bank Nifty future trend as per the one standard deviation formula. And these are the reference prices I have taken, and based on this, we have just released this. This is the levels valid from 29th August to 2nd September. Using the one standard deviation, above 8659 trend is off, below 8600 trend is down, and once this uptrend starts, it has the maximum probability till 8834, and in between the fast target is being set at 8708. Same way in the downtrend for Bank Nifty starts at 19,196, uptrend starts at 19,444. And if this uptrend breakout gives, it is having the probability to touch 19,800. The fast target is 19,520. Same way the downtrend fast target is 19,020, and if that breaks, then final target we may expect 18,797. So this is the levels for the Nifty and Bank Nifty as per the one standard deviation formula we have derived for the week. And you can also download the PDF report from here, and which you can preserve for your future reference. So this is the levels for the next week Nifty and Bank Nifty as per the one standard deviation. So this report, as I told, every week we used to release this report, and you can take the benefit of this report by visiting our website. So this is the trend report for the Nifty and Bank Nifty for coming week. What strategy? So when to initiate what kind of strategy, that is the aim of our today's session. And so there is, you can say, options has some Greeks which is known as your delta, theta, vega. As I told you yesterday, delta represents the change in the option premium, percentage change in the option premium with each percentage change in the underlying asset. So theta represents each percentage change in the options time value for each one day you near to the expiry, and vega represents the percentage changes in the option premium with each 1% change in the volatility. So this is what the options Greeks meaning is. So whenever we form the strategies, broadly the strategies are being divided into two categories. One is the net credit strategies, net credit, and another is the net debit. So whenever you form any strategy, and by the formation of strategy you receive some money into your account, that is known as your net credit. And whenever you form any strategy, by that action of forming the strategy, you pay some money to the market, that is known as your net debit strategy. For example, if you are just buying, so for example, I am just taking 8,500 call, and which is at, you can say, or I can say 8,700 call, I am assuming it is at 80 rupees, and I am taking 8,800 call. So this is European, so I will make it E. So this 8,800 call, which is at 60. So net credit strategy said that if you sell this first one 8,700 and buy the second one, so at 60, so you receive 20 rupees credit. So 20 rupees into lot size whatever may be, that is your credit. So that is called a net credit strategy. Then if you do in a reverse order, suppose if you buy the first one by paying 80 and sell the second one by paying 60, then it is called as a net debit strategy. So when the money flow into your account, it is net credit. When the money flow out of your account, it is known as the net debit strategy. So this formation of strategy broadly classified into two categories, net credit and net debit strategies. Then We again reclassify those strategies. Again we reclassify those strategies. We reclassify those strategies based on our objective. So that objective, whenever we set those objectives will be Greek neutral strategies, means delta neutral, vega neutral, theta neutral, based on which are the factors we want to neutralize. So suppose I want that my strategy should not be impacted the by the suppose I want that my strategy should not be impacted by the time value decay of the options, then I can say that is called as my net or theta neutral I can derive. And sometimes people used to say that neutral means time value decay won't impact me. Neutral means intrinsic value growth will not impact me. That is not the truth. Sometimes they say that if I am having a vega neutral strategy, then volatility will not impact me. That is not the truth. The truth of strategy formation is the neutral means how much amount of risk you just want to carry. So that is the meaning of the neutral. Neutral doesn't specify that we are going to derive a vega zero. That means that volatility will not impact us at all. So it will impact, it will definitely have some implication on our strategy. Irrespective of deriving that neutralness to zero or positive or negative, we will be still impacted through the market movement. So it is just to certain extent to protect our money, so we can derive specific neutralness. So broadly I have told you net credit strategies, net debit strategies, then based on your objective you form any Greek neutral strategies. Now coming to the most important part of my discussion, when to form which strategy. So while forming these strategies, any option strategy whenever you form, first you need to look into the trend. Look at the trend. So without a trend breakout, if you form a strategy, then it won't yield you any profit. You have to keep it very carefully. You have to understand this part and keep it in writing. Without the trend confirmation, if you form any kind of strategy, then that won't yield any profit. Rather, it will be giving you some amount of losses. So trend is very important. First we have to look into the trend. So suppose this is the Nifty trend for 29th August to 2nd September, and 8660 above my trend is up, 8600 below my trend is down, and it is settled at 8630. So Monday, once market opens, it is opening somewhere, so it will give some breakout either in the upside or downside. Some breakouts we can get. So we need to wait for a trend breakout. Imagine we are getting a downtrend breakout, 8600 downtrend breakout we got. We have calculated a weekly trend, and based on this weekly trend I am telling that assume you have got a downtrend breakout of 8600. So once you get this downtrend breakout, you have two choices here. I got a downtrend breakout. So whether I should form a net credit strategy or net debit strategy. Net credit strategy or net debit strategy. You have two choices. So once you form a net credit strategy, suppose if you want to form, means I want to receive some money from the market, and this is the 8600 downtrend breakout has come, and I am forming the credit strategy. So here, once you are forming a net credit strategy, you have to form in the call side. The first example what I have given you. Same way you can form. You can sell 8600 call and buy some 8700 call. So this is the net credit strategy you can form. Or if you just want that, no, I cannot form a net credit strategy and I will just form a net debit strategy, then you can also form in this order: buy 8,600 put and sell 8,500 put. So this is also net debit strategy. So you need to decide whether I want a credit strategy or a debit strategy. So when this downtrend breakout has happened, you have two choices. If you form a credit strategy, whatever amount you have received, that is your maximum gain. If you form a net debit strategy, whatever money you have paid in this particular strategy, that may be your maximum losses, and profit you have to calculate based on the what is the nature of the strategy is. So this is a credit strategy and debit strategy. But that is not our objective. Our objective is which one we should form. Which strategy will be best suitable at this particular point of time. So in this point, you need to look into that which phase of the settlement cycle you are in. So you are in the first week of the settlement cycle for the September. So if I just take this particular example for 29th August to 2nd September, this particular week if I am taking, then you are in the first week of the settlement cycle of the September. In the first week of the settlement cycle, most of the options will be having a higher time value. It will be having a higher time value component. So for that, if I am going to form a option strategy in the first week of the settlement cycle, first or second week of the settlement cycle, first week of the settlement cycle or the second week of the settlement cycle, it is better to form net credit strategy. Net credit strategy. It is better to form net credit strategy because I am in the first or second week of the settlement cycle, and in this particular week I have greater probability to decay in the time value. Henceforth, if I form a net credit strategy, that will be better choice for me. So that will be a best choice for me if I form a net credit strategy. The net credit strategy must be validated with a trend breakout. Why we form a net credit strategy? Because this first week or the second week will be having a higher component of time value, which we can convert to our side as a profit. So this is what for which this is the reason or cause or the aim or vision for which we should make it as a net credit strategy. Now coming to the next part. So this is based on a trend breakout we have got it. However, sometimes the put call ratio analysis also is very important. Trend has given you a breakout on the downtrend side. Imagine a situation, your trend breakout has happened at 8,600 downtrend side. However, put call ratio is saying that it is at 1.05. So in this particular situation, put call ratio of the Nifty says that this is 1.05 and downtrend breakout has come. Till this put call ratio has not fallen below 0.85. You cannot say that it is having a downtrend. Just downtrend is being set, but it is not being confirmed. So you may say that it may go to the fast target. However, at this particular point of fast target, I need to investigate whether my put call ratio has given any breakout below 0.85. If it is not, then there is a bounce back is possible. There is a bounce back possible in this particular counter. So if I form a net credit strategy here, when the put call ratio is 1.05, because the trend has just started, downtrend is just started, and I need to wait till the first target, and then I need to re-inspect the put call ratio. If this put call ratio still says that it is 1.9, 0.8, sorry, 0.9, 0.95, if it is giving you such kind of such kind of results in the put call ratio front, then better close the strategy and come out. You form a net credit strategy as per the trend breakout, nothing wrong in that. However, looking into the put call ratio is also important here. If the put call ratio has given you a clear indication that yes, the downtrend has started and it has gone below 0.85, nothing wrong, you just hold it. Once the price comes to the second or third target, your profit will be maximum. Or else, whatever the little profit you got, in that you have to come out because there is a bounce back is possible. So once such kind of thing happened and you come out from, because here you initiated, you have achieved 8552 and put call ratio says that it has just come down to, suppose you can say 0.9 level, 0.9 level, it has not given you a clear trend breakout region, and here your net credit strategy is at a small profit, you have come out from there. So but full call ratio says that there is a bounce back is possible because it is not given you, in spite of having a 3 level of penetration as per Fibonacci, the put call ratio has not given you any significant breakout and said you that yes, the downtrend is being started. So at this particular point of time, forming a net debit strategy in the call options is advisable, or you can form a net credit strategy in the put options also advisable. So if there is a bounce back, then this it means net credit means you can sell 8,550 put option and you can think of buying, this is the means last target is coming to, so 8425, you can think of buying 8,450 put option. So by this process you can form a net credit strategy in the put side, looking at in this put call ratio, and then wait for a little bounce back, you can get some profit. And one thing you have to very carefully understand and remember here, most of the time the option sellers used to be get benefited. Option sellers used to get maximum benefit of the option trade as compared to the option buyers. This is a conventional term and it is a true term in the trading. Henceforth, forming net credit strategy by looking at the trend and looking at the put call ratio will be the best idea to make money in the option strategy. And option strategy not only concludes this part, in option strategy little bit of thought process is required. This is not for the traders, those who do not trust on mathematics, do not have a basic skill of mathematical understanding. It is only for the traders, those who plan their trade and little bit having some thought process they need to involve in the trade. So this is how we should trade in the options. And this put call ratio, what you have seen in this Nifty now, what you are seeing in the Nifty now, currently we have a put call ratio of 1.09, but series is just starting. Only one day it is gone in the series. So just wait for 2 to 3 days, minimum 2 to 3 days time you should give, so that you will get a clear indication of the put call ratio. So Monday if market opens, just Monday or Tuesday if you can give 2 more days, then you can get a clear indication of the put call ratio. So here once again I will simplify this option strategy requirement. Your option strategy requirement having a net credit or net debit. When we come to a point when to form which strategy, that time we are looking into 2 factors. One is the trend breakout, second is the put call ratio. Based on trend breakout we initiate a strategy, then we look into this. If there is no stop loss triggering happens, then we need to reinvestigate the put call ratio at any one of the target point to say that whether that same trend is going to continue or that trend is going to reverse from that. So after looking into that put call ratios trend confirmations, then we take our second call whether to quit that particular trade at a small profit and initiate a new trade or to continue with that particular trade. So this is what the most simplest way you can implement a strategy for your practice. Any query you can ask me. Form what kind of strategy, and your strategy must have the validations of why you are initiating this strategy. I have given a broad range of articles here. How to use 1SD level for to form option strategy, how to do intraday positional trade, covered call option strategy, multiple bull and bear spread using 1SD, how to profit from cross calendar option strategy, how to make profit in saddles option strategy. So if you just look into these articles, the article number 1, this one, article number 2, article number 3, article number 4, article number 5, all these articles I have just given a brief description with the backtesting, evidence how to work on the strategies by looking at in the one standard deviation trend parameter. One standard deviation trend parameter, by looking at that, how to form the option strategy I have elaborately given. So just spend some time, read these 5 articles seriously. If you just take a printout of this thing and keep as a reference also, it is better. These 5 strategies also, if these 5 articles, whatever the strategies it covers, if you practice only those strategies also, you will be successful in the option strategy making. So you will become successful in the option strategy making, because you have to think option strategy in the most simplest point of view. Then only you can start making some money, and once you mature in that, you can implement the advanced strategies or complex strategies. And it has a great domain. You have adjustments to do, you have many means multiple Greeks to neutralize, many things is there. But if you just go into these particular articles and just start implementing these small strategies based on your trend, based on your PCR analysis, based on your put call priority ratio analysis, once you just go and practice this particular strategy, even though if you are not trading in options, try to practice these strategies as a paper trade for a couple of months, then you will find out the difference. And option strategy is for the traders, those who have a long-term mission to achieve in the market. It is not for the traders, those who want that in overnight itself I will become millionaire. Those traders will never stay in the market for a long time. It is just they have come to lose some money, and once they lose the money, they will go out. So that is for them. However, option strategy is for the traders, those who aim to stay long in the market. So this is about the option strategy. You still have some query to clarify. For all our buyers, you can post your queries either to admin@smartfinancing.com or this Gmail ID. So you post your queries, I can answer your queries for that. And also we are running the offer now, this for our entire course and softwares, which we used to sell at a regular discount of 17,500. It is available at 15,500, valid today till end of the day, 27th August it is valid. If you wish to purchase, you can call to our sales number here.